Jerome Powell recently spoke about his plans to fight inflation, and the market didn't take it too well. The Federal Reserve is stuck between a rock and a hard place. The rock is record high inflation, and the hard place is economic pain caused by rising interest rates. And ARK Invest's funds could feel that pain much more than everyone else. They may even be due for another collapse. So in this episode, we'll go over exactly what Jerome Powell said he's willing to do to fight inflation, and what that could mean for growth stocks, like the ones held by Cathie Wood over at ARK Invest. Your time is valuable, so let's get right into it. Let's start with Jerome Powell's recent comments. It's important to hear these things straight from the source. I've cut them down to just the most important parts, but I'll also include a link to the full video in the description below if you need more context.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Our responsibility to deliver price stability is unconditional.
So one thing I really appreciate is that Jerome Powell spoke in no uncertain terms. The Federal Reserve remains focused on using every tool they have to fight inflation, almost at any economic cost. In case you didn't know, the Federal Reserve actually has two main goals: keeping prices stable and keeping unemployment low. Those two goals are actually opposite sides of the same coin. Here's how they relate to each other. When unemployment is low and almost everyone has a job, almost everyone has the money to buy goods and services. That means demand goes up while the supply of those goods and services stays mostly the same. For example, a restaurant or a movie theater can only hold so many people, and stores can only really have so much inventory, especially with all the supply chain issues still going on. So what do these businesses do? They raise their prices as much as they can, until their sales drop below their expected inventory levels. On the other hand, if unemployment gets too high, there's way more inventory supply relative to demand, since people can't afford to buy those same goods and services. So prices start to come down until more people can afford to buy, which increases relative demand. There's a sweet spot that the Fed is aiming for between keeping unemployment low enough and keeping prices stable enough. That usually means inflation is around 2%, which is well below the 8% or more that we're currently seeing. At the same time, the Federal Reserve is still seeing a strong labor market, meaning that companies are still looking to hire. That means the Fed has some room to keep raising interest rates and eat into this demand for additional workers before companies have to start cutting their existing employees. And even when that economic pain does begin, the Fed could keep interest rates restrictively high for an extended period of time, since 1 month of lower inflation data isn't really enough for the Fed to think that prices have stabilized. Now that we've talked about what this could mean for the economy, let's talk about what it could mean for the stock market, starting with this quick CNBC clip reacting to Jerome Powell's comments.
This was a hawkish speech, full stop. The Fed chair said his message was, quote, going to be more direct. Restoring price stability will take some time by using our tools forcefully. He said another, quote, unusually large increase could be appropriate at the next meeting. Decision will be dependent on incoming data. He cited Paul Volcker. He said we must keep at it until the job is done. Said there's going to be some pain as a result. Leisman pointing out today that, in fact, shows how resolute the Fed is going to be. And with all of that, you say what?
So first off, I say this is not a surprise. OK, he wanted to take off the table, Scott, the idea that rate cuts were coming anytime soon. That idea should not have been on the table. Everybody for the last month plus has been saying that, look, we're going to raise above restrictive. Everybody in the Fed governance committee has been saying we're going to raise above restrictive levels and then we're going to stay there. OK, so that should not have been a surprise. What he said is that he's going to be data dependent. 1 month is not enough. Again, that should not have been surprising.
Did he really say he was going to be data dependent?
That's what I heard. What he said, and I listened, you listened, he said, I want to see the totality of data before making the decision. Those were more or less his exact words. The totality of data was a phrase that he used.
I feel like they're going to put a sledgehammer on the economy, Steve Weiss, and then they may be data dependent on what happens next. But this was about as hawkish as you've ever heard this Fed chair, I thought.
About as hawkish as we've ever heard, removing any notion that rate cuts could be coming soon, a sledgehammer to the economy. I actually agree with this assessment, and like I've been saying for months now, I'm surprised that the market has been rallying at all in the face of sustained 8 to 9% inflation. The longer inflation stays high as interest rates continue to rise, the longer it should take to cool off, or the higher interest rates need to be to really crack it. This is a real double whammy for growth stocks, because rising interest rates also make bond yields rise. Since bonds are safe investments, higher yields mean that stocks need to perform even better to justify the added risk of buying them instead of safer, better performing bonds. This is especially true for high-risk growth stocks, which means their prices begin to fall faster, which starts a negative feedback loop as lower stock prices and higher interest rates both make it more expensive for companies to raise capital. And when capital gets more expensive, there's less money to reinvest in future growth, which lowers future expectations, which lowers the stock price even more. Since ARK Invest's portfolios are mostly filled with companies that are still heavily investing in their own growth, almost no one is more at the mercy of rising interest rates than Cathie Wood. So let's take a look at ARK Invest's top holdings right now when you combine their 6 actively managed funds. The darkest blue bars are what's in ARKk, which is ARK Invest's flagship innovation fund and their biggest fund by far. ARKg and ARKw are the next biggest funds, followed by ARKf, ARKq, and ARKx. The top x-axis of this bar chart shows the percentage of ARK Invest's total holdings that one stock represents, and the bottom x-axis shows the total number of dollars that ARK has invested in that stock. So for example, Tesla is Cathie Wood's biggest position by far. The ARK Invest funds have over $1.1 billion in Tesla across ARKk, ARKw, and ARKq, which is around 7% of their total assets under management. Then they have almost $800 million of Zoom stock, $750 million of Roku stock, $650 million of Teladoc stock, and on and on. So as you can see, these are all high-tech growth stocks that are valued mostly based on their earnings a few years out. That's why ARK Invest's funds have collapsed in price by around 66% since the Fed announced that they'd be raising interest rates late last year. Here's what Cathie Wood had to say about the latest round of interest rate increases in her most recent episode of In the Know, which comes out on the first Friday of each month along with economic and unemployment data.
In the fixed income markets, of course, the Fed increased, and everyone anticipated that the Fed would increase interest rates by 75 basis points on July 27th. That happened. But interestingly, the long-term interest rates did not cooperate or have not been cooperating with this idea that they should be going up in lockstep with what the Fed is doing. Instead, what we're seeing is we have an inverted yield curve to the tune of 41 basis points. It's just getting more and more inverted. And that's basically the fixed income markets telling the Fed, something's going to give here. It's going to be the economy, which is caving in many ways, or inflation, or both. And we think the answer is both. And we also think, and I'll get into this in a moment, that the surprises are going to be quite significant on the downside when it comes to inflation.
Cathie Wood has been very consistent in saying that she believes that inflation is transitory. Transitory doesn't mean short-lived, although Cathie Wood's stance seems to suggest that she thought that it would be short-lived. It just means that inflation isn't baked into the system. Instead, inflation is the result of several different factors coming together, like supply chain issues, the war between Russia and Ukraine, and the pent-up demand from the pandemic shutdowns. If those issues can be fully resolved, then we should see inflation start to crack. Add in the Federal Reserve's sharp increases in interest rates, and Cathie Wood is expecting that inflation numbers start falling faster than the market expects. If she's right, ARK Invest funds stand to benefit the most, since the growth stocks I just highlighted tend to shoot up very quickly when interest rates become lower than expected. If she's wrong, though, and the Federal Reserve continues to raise interest rates higher than expected, ARK Invest funds could collapse all over again. I'm not trying to be a fearmonger here, and I definitely don't have all the answers. My point in getting all this information together for you is to show you both sides of the inflation argument and what it could mean for growth stocks before the next FOMC meeting, which will take place on September 21st and 22nd. That way, you can do what's right for you before the Fed raises interest rates, possibly more than the market expects. Cathie Wood should also have another video out before that meeting where she gets a chance to respond to the Fed's latest statements. I'll make sure to update you when that comes out as well. Hopefully this episode clarified the Fed's latest comments on inflation and interest rates and what it could mean for growth stocks in the very near future. So if you think I've earned it, consider hitting the like and subscribe buttons to let me know that you find this kind of content valuable. As for me, I'm still doing exactly what I've been saying for a few months now, staying the course, saving up more cash, and researching all of my favorite growth stocks to see how they've been adjusting their strategies during these crazy times. Want to know which companies I'm most bullish on when it comes to full self-driving? Check out this episode next. Or if you want to know which company I think is killing it in data centers and hyperscale computing, this episode is for you. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.